Let me tell you something that might surprise you. After spending the last 3 years selling stocks and building up the largest cash pile in Berkshire's history, $381 billion, we just made a bet that's raised eyebrows across Wall Street. We bought $4.3 billion worth of Alphabet, Google's parent company. Now I know what you're thinking. Warren, you've been selling everything, including 2/3 of your Apple shares. Why are you suddenly jumping into tech stocks? Here's the thing. For years, Charlie and I sat there, as he would say, sucking our thumbs, while Google grew into one of the most profitable businesses ever created. Back in 2019, we admitted publicly that we screwed up. We watched Geico pay Google $10 every time someone clicked one of their ads. We saw how their advertising model worked, how profitable it was, and we did nothing. This purchase represents one of the final major investment decisions I'll oversee as CEO before Greg Abel takes the reins in January. And I want to explain to you exactly why, in a market I consider dangerously overvalued, this particular investment makes sense, and why you need to understand both the opportunity and the very real risks involved. Let me start with a story from Omaha. Back when Geico was just getting started with online advertising in the early 2000s, they came to me with their numbers. They were paying Google about $10 every time someone clicked on one of their search ads. Now, most people would have looked at that number and thought, that's expensive. But I looked at it differently. I asked, how many of those clicks turned into customers? The answer was impressive. Google's targeting was so precise that Geico was making money hand over fist on those clicks. I should have done the math right then. If one company was willing to pay $10 per click and making money, how many other companies were doing the same thing? How profitable must Google's business be? The margins on selling advertising at scale are extraordinary once you've built the infrastructure. Every additional ad you sell is almost pure profit. Charlie and I both saw it. We both understood it. And we both sat there and did nothing. That's what Charlie meant when he said we were sucking our thumbs at the 2019 shareholder meeting. Now in November 2025, Alphabet just reported something remarkable. They crossed $100 billion in quarterly revenue for the first time in history. That's not a typo. $102.35 billion in 3 months. Net income hit $35 billion, up 33% from last year. And here's what matters. This isn't some speculative business burning cash to chase growth. They generated $24.5 billion in free cash flow in just 1 quarter. Over the trailing 12 months, that's $73.6 billion in cash they pulled out of the business after all expenses and capital investments. Let's talk about what we're really buying here. Google Search brought in $56.57 billion in the quarter, up 15%. Despite all the talk about ChatGPT and AI disrupting search, Google is growing faster now than it was a year ago. Why? Because they've integrated AI into search in a way that makes it better, not obsolete. Their AI overviews and AI mode are driving more searches, not fewer. And the monetization rates on AI-enhanced search are roughly the same as traditional search. That means they're making just as much money per search while getting more searches. YouTube advertising hit $10.26 billion, also up 15%. But here's what most people miss. YouTube's subscription business is growing even faster. When you combine advertising and subscriptions, YouTube has become one of the most valuable media properties on earth. It's the #1 platform for streaming watch time in America. It's not competing with TikTok or Instagram. It's competing with traditional television, and it's winning. Then there's Google Cloud, which grew 34% to $15.16 billion. Now this is where the AI story gets interesting. Cloud went from being a money loser, dragging down margins, to generating $3.6 billion in operating income, with a 23.7% operating margin. They've signed more deals over $1 billion this year than they did in the previous 2 years combined. They have a $155 billion backlog. That's contracted future revenue from customers who've already committed to spending. But let me be clear about something. We're not buying Alphabet because we think AI is going to take over the world and create infinite value. We're buying it because it's a profitable business today with a reasonable price relative to its earnings. The PE ratio is around 27 times earnings. Compare that to Microsoft at 31.8, NVIDIA at 31.8, or Broadcom at 40.7. More importantly, look at the forward PE, about 22 times what they're expected to earn in 2027. For a business growing revenue 16% and earnings 33%, with rock-solid free cash flow, that's not an unreasonable price. Here's what I learned over 60 years. You don't need to predict the future perfectly. You need to buy good businesses at fair prices and not overpay. Alphabet has a moat, a real competitive advantage. Google processes billions of searches every day. Each search makes their algorithm smarter. That creates a flywheel that's very hard for competitors to break. YouTube has a similar advantage. Creators come to YouTube because that's where the viewers are, and viewers come because that's where the creators are. Now you might ask, Warren, if this is such a good business at a reasonable price, why did you wait until now? Fair question. The truth is, I should have bought it years ago. Charlie was right. We screwed up. But one thing I've learned is that beating yourself up over past mistakes doesn't help. What helps is recognizing when you have a second chance and taking it. The timing matters too. We've been selling stocks for 12 consecutive quarters. We sold 2/3 of our Apple position. We trimmed Bank of America. We've been net sellers because prices got ahead of value. But as valuations come down, even slightly, on businesses we understand and admire, we'll deploy capital. That's what we did here. Let me also be honest about something else. This purchase was likely initiated by Todd Combs or Ted Weschler, the two investment managers who handle portions of our portfolio. I oversee the largest investments, but these gentlemen have done excellent work. They understand technology businesses better than I ever did. But make no mistake, a $4.3 billion position, which makes Alphabet our 10th largest holding, required my approval. And I gave it because the business case makes sense. Now, let me tell you what worries me. And this is important, so pay attention. The artificial intelligence boom we're living through right now has all the hallmarks of a speculative bubble. I've lived through enough bubbles to recognize the pattern. The dot-com bubble in 2000, the housing bubble in 2008, and I'm seeing similar warning signs today. Companies are spending money they don't have on infrastructure they might not need, chasing revenues that may never materialize. OpenAI, which makes ChatGPT, has committed to $1 trillion in deals this year. $1 trillion. Yet they're projected to bring in just $13 billion in revenue. They're losing billions annually. Their valuation has jumped from $300 billion to $500 billion in less than a year. Does that sound familiar? It should. It's exactly what happened in 1999, when companies with no profits were valued in the billions based on eyeballs and potential. But here's the difference, and why we still bought Alphabet. When the dot-com bubble burst, most of those companies went to zero because they had no real business. Pets.com had revenue, but no path to profitability. Webvan spent hundreds of millions on infrastructure for a business model that didn't work. Most of those companies deserved to fail because they weren't real businesses. They were stories dressed up as investments. Alphabet is not Pets.com. Alphabet is printing money. Last quarter alone, they generated more profit than most companies generate in revenue. Their business is real. Their customers are real. Their cash flow is very, very real. So yes, there's a bubble in AI stocks. Yes, valuations across tech are stretched. But when you're buying a profitable business at a reasonable multiple of earnings, you have a margin of safety. If AI turns out to be overhyped, Alphabet still has Google Search. They still have YouTube. They still have cloud, which is profitable today. Let me walk you through the math because this is important. Alphabet is spending between $91 billion and $93 billion on capital expenditures this year. That's a huge number, and it's going up significantly in 2026. Most of that money is going into data centers, servers, and chips for AI infrastructure. Now, if AI turns out to be a bust, that's $90 billion that might not generate the returns they're hoping for. But here's what gives me comfort. First, unlike most companies chasing AI, Alphabet can afford it. They're generating $73.6 billion in free cash flow annually before those capital investments. They have $98.5 billion in cash on the balance sheet. They're not borrowing money or diluting shareholders to fund this spending. They're using money they earned. That's a critical difference. Second, even if AI doesn't work out exactly as planned, the infrastructure isn't worthless. Cloud computing was growing before AI became the hot topic, and it'll keep growing after the hype dies down. Businesses need computing power. They need storage. They need all the services Google Cloud provides. The AI boom is accelerating that spending, but it's not creating it from nothing. Third, and this is crucial, Alphabet's core businesses aren't dependent on AI working perfectly. Search makes money today. YouTube makes money today. Cloud makes money today. The AI investments are about making those businesses better and opening new opportunities, not about pivoting to an entirely unproven business model. Now, compare that to the real AI bubble stocks. Companies with no revenue raising billions at absurd valuations. Companies with massive losses and no clear path to profitability. Companies where insiders are investing in each other, creating circular flows of money that inflate everyone's valuations artificially. That's where the bubble is. That's where people are going to lose their shirts. The Bank of England recently warned about this. The IMF echoed those concerns. Michael Burry, the guy who predicted the housing crisis, is betting against some of these companies. Jamie Dimon at JP Morgan says AI is real, but a lot of money will be wasted. He's right on both counts. Here's what history teaches us. When a genuine technological revolution happens, most of the companies trying to capitalize on it fail. Look at the automobile industry. Cars changed the world, absolutely transformed society. But of the thousands of car companies that existed in the early 1900s, only a handful survived. The technology was real, the revolution was real, but most of the companies betting on it failed anyway. The same thing happened with the internet. The dot-com bubble burst in 2000, wiping out trillions in market value. But the internet didn't go away. It kept growing. It changed everything. The companies that survived, Amazon, Google, Microsoft, became some of the most valuable businesses in history. But you had to be extremely selective. You had to buy businesses that could survive the bust and emerge stronger. That's what we're doing with Alphabet. We're not betting that every AI company will succeed. We're not even betting that AI will be as transformative as people think. We're betting that Alphabet is well positioned to benefit if AI works out, and well protected if it doesn't. That's called asymmetric risk, and it's how we've made money for decades. Let me give you a specific example. Google's Gemini app now has 650 million monthly active users. That's enormous scale. But unlike OpenAI, Google isn't charging people $20 a month for it. They're integrating it into search, into cloud, into their whole ecosystem. That means they can monetize it in multiple ways. They can make money from advertising. They can make money from subscriptions. They can make money from enterprise customers. They don't need Gemini to be a standalone billion-dollar business. They just need it to make their existing billion-dollar businesses better. That's a much safer bet than hoping people will pay $2,000 a month for an AI assistant, which is what some companies are suggesting. I'm 95 years old. I've seen a lot of things, and I've never seen a sustainable business model built on hoping consumers will suddenly pay 100 times more for something they're getting for free or cheap today. So yes, there's a bubble. Yes, people are going to lose money. But we're not buying Alphabet because of the bubble. We're buying it despite the bubble. We're buying it because underneath all the hype, there's a real business making real money, and it's trading at a price that makes sense relative to that reality. Let me talk directly to you now, because this Alphabet purchase teaches a lesson that's bigger than just this one stock. For 3 years, we've been selling. People have asked me constantly, Warren, why are you selling? The market keeps going up. You're missing out on gains. Let me tell you something that most people don't understand. Missing out on gains is not the same as losing money. If I sell a stock at $100 and it goes to $150, I didn't lose $50. I made whatever profit I had when I sold. The opportunity cost is real, but it's not the same as an actual loss. Now here's the important part. When you're sitting on $381 billion in cash, You can afford to wait for the right opportunity. You can afford to miss out on some gains in an overheated market because you're preserving capital for when things get cheaper. That's not market timing in the traditional sense. I don't know if stocks are going to crash next month or next year, but I do know that at some point, valuations will come back to earth. And when they do, we'll be ready. This Alphabet purchase is a perfect example. We're not saying the market has bottomed. We're not saying valuations are cheap across the board. We're saying that in this specific case, with this specific business, at this specific price, the math works. That's very different from jumping in with both feet and buying everything because you're afraid of missing out. Let me explain what I mean by the math works. When I evaluate an investment, I'm thinking about intrinsic value. What is this business actually worth based on the cash it can generate over its lifetime? For Alphabet, I'm looking at a business that made $124 billion in profit over the last 12 months. I'm looking at free cash flow of $73.6 billion. I'm looking at revenue growing 16% and earnings growing even faster. Now, will they keep growing at 16% forever? Of course not. Growth always slows down eventually. But even if growth slows to 10%, then 7%, then 5%, this business will generate hundreds of billions in cash over the next decade. At a $3.4 trillion market cap, you're paying about 27 times this year's earnings, or about 22 times what they'll probably earn in 2027. For a business of this quality, with these margins, with this competitive position, that's not an outrageous price. Compare that to buying NVIDIA at 31.8 times earnings, when most of their revenue is tied to AI infrastructure spending that could slow down dramatically if companies decide they've built enough data centers. Or compare it to buying some AI startup at a $10 billion valuation with $50 million in revenue and massive losses. The risk-reward is completely different. Here's what you need to understand. In investing, you make money by doing two things right. First, you don't lose money. That sounds simple, but it's the most important rule. If you lose 50% of your money, you need to make 100% just to get back to even. The math of losses is brutal. So your first job is to avoid the big mistakes, the bets that can wipe you out. Second, you find businesses that can compound value over long periods. That's how wealth gets built. Not by taking a flyer on the hot stock and hoping to make 1,000% in a year. That's gambling. Real investing is finding a business you understand, buying it at a sensible price, and letting the business do what good businesses do: grow steadily and generate cash. Alphabet fits that description. It's not the sexiest story on Wall Street right now. It's not some startup promising to revolutionize everything with AI. It's a 25-year-old company with multiple mature businesses, all generating huge amounts of cash. And that's exactly what I want to own. Now let me address something important. Some of you might be thinking, but Warren, you said the market is overvalued. You've been selling for 3 years. If you think things are expensive, why buy anything at all? It's a fair question. Here's the answer. I never said we'd stop buying completely. I said we'd be very selective. When you have $381 billion in cash, you can't just sit on it forever, waiting for the perfect moment. That cash needs to be deployed eventually. But we're going to deploy it carefully, one opportunity at a time, when we find businesses at prices that make sense. Think of it this way. If you're in a grocery store and most items are overpriced, you don't buy everything just because you need groceries. But if you find one or two items that are reasonably priced for what they are, you buy those. That's what we're doing. We're being selective. Most stocks are too expensive, but Alphabet at this price, with this business quality, passes our test. Let me also be clear about what we're not doing. We're not buying Alphabet because we think it's going to triple in the next year. We're not buying it because we think AI is going to create unlimited value and Alphabet will capture it all. We're buying it because over the next 5, 10, 15 years, this business will probably generate hundreds of billions in cash flow. And at today's price, we're getting a decent return on that cash flow. That's it. No magic, no genius predictions about the future, just basic math and business fundamentals. Here's a specific example of how we think about it. Let's say Alphabet earns $150 billion in 2027. At 22 times earnings, that suggests the market thinks the business is worth $3.3 trillion. If earnings keep growing at even 8 to 10% annually after that, not the 20 to 30% growth of the early years, but mature business growth, then in 10 years, they could be earning $300 billion annually. If the multiple stays at 22, that's a $6.6 trillion company. If it compresses to 18, that's still a $5.4 trillion company. Either way, from today's $3.4 trillion valuation, you're looking at reasonable returns if the business executes. And here's the key. Those returns don't require AI to revolutionize the world. They just require Google search to stay dominant, YouTube to keep growing, and cloud to capture its fair share of the market. Those are much safer bets than hoping some speculative AI company turns into the next big thing. So what's the lesson for you? It's simple. Be patient. Don't chase the hot stocks. Don't get caught up in the hype. Wait for businesses you understand, trading at prices that make mathematical sense. And when you find them, buy them, even if everyone else is talking about something sexier. That's what we did with Alphabet. That's what we've done for 60 years. And that's what will keep working long after I'm gone. Let me bring this home with something important. I'm stepping down as CEO in January. Greg Abel is taking over. This Alphabet purchase is likely one of my last major investment decisions at Berkshire Hathaway. And I want you to understand why I'm comfortable leaving this investment for Greg, and why you should think carefully about what this position represents. First, this isn't about me trying to prove I can still pick tech stocks. I freely admit I missed Google the first time, and the second time, and probably the third time too. Charlie was right. We sat there sucking our thumbs when we should have been buying. This purchase is about correcting that mistake when the opportunity finally presents itself at a reasonable price. Second, this shows you what real value investing looks like in 2025. It's not about buying only old economy businesses. It's not about avoiding technology. It's about understanding what you're buying, knowing what you're willing to pay, and having the discipline to wait for the price to match the value. Alphabet at $285 per share, with a PE of 27 and massive free cash flow, is a value investment. It might not look like Coca-Cola or See's Candies, but the principle is the same. Third, and this is critical, even when making a bet we believe in, we're sizing it appropriately. This is our 10th largest position. It's not tiny, but it's not huge either. That's risk management. If we're wrong about AI spending, if Google search faces more competitive pressure than we expect, if something goes sideways, it won't sink Berkshire. But if we're right, it'll contribute meaningfully to our returns. Fourth, pay attention to what we're doing with that $381 billion in cash. We're not deploying it all at once. We're not saying the market has bottomed. We're being opportunistic, one investment at a time. This is how you should think about your own investments too. You don't need to be fully invested or fully in cash. You can move gradually, responding to opportunities as they appear. Let me tell you what worries me most. The concentration in the market right now is extreme. 5 companies make up 30% of the S&P 500. That's the highest concentration in 50 years. When that much weight sits on so few stocks, bad things can happen. If AI disappoints, if growth slows, if valuations contract, those 5 stocks could take the whole market down with them. That's exactly why we've been building this cash position. Not because we're predicting a crash, but because we're preparing for one. When it comes, and it will come eventually, it always does, we'll be ready to buy great businesses at much better prices. That's the game. That's how you build wealth over decades. Is Alphabet a good bet? Yes, I think so. At this price, with this business quality, the odds are in our favor. But make no mistake, it's a bet, not a sure thing. And that's why we size it appropriately and keep plenty of cash on hand. So here's what I want you to remember. We bought $4.3 billion of Alphabet, not because we think we've found the next Amazon in its early days. We bought it because it's a mature, profitable business trading at a reasonable price in an otherwise expensive market. We're correcting a mistake Charlie and I made years ago when we didn't buy it. And we're doing it at a price that makes mathematical sense. The AI bubble is real. Companies are going to lose billions chasing something they don't understand. Valuations are stretched across most of tech. But beneath all that noise, there are still some good businesses trading at fair prices. Alphabet is one of them. As I hand over Berkshire to Greg Abel, I'm comfortable with this position because it represents everything we've believed for 60 years. Buy good businesses at fair prices. Size your bets appropriately and keep plenty of cash for opportunities. That approach worked when Charlie and I were buying textile mills, insurance companies, and See's Candies. It works today buying Google, and it'll keep working long after I'm gone. That's the only investing wisdom I've ever had, and it's the only wisdom you'll ever need.